It is always a little surreal when a company that literally builds stealth bombers and moon rockets gets derailed by an office software upgrade. Welcome to Earnings Unscripted. Today is April 23rd, 2026, and we are unpacking Lockheed Martin, ticker LMT, for their first quarter.
Yeah, that is peak irony. They can coordinate drone swarms in contested airspace, but getting their billing system to actually issue invoices, that is apparently where the wheels come off.
Which is so incredibly relatable. And actually, before we dive into just how much cash an IT glitch can burn, quick reminder that our opinions are not financial advice, just two friends reacting to the filings. But Mira, looking at these headline numbers, it was a pretty rough landing today.
Very rough. You look at the top line and revenue came in at $18.02 billion. That is basically flat year over year. But the bottom line really took a hit. Earnings were $6.44 a share, down almost 12% from last year, and operating income dropped 13% to $2.06 billion.
Right. And just to note for everyone, they did not provide sequential quarter-over-quarter income numbers this time. Because of how they did their year-end reporting, we are strictly comparing this to early 2025.
Exactly. But honestly, the number that really spooked everyone was the free cash flow. It went negative. $291 million flowing out the door compared to almost $1 billion coming in this time last year?
Geez, which goes back to the billing software thing. They explicitly blamed an enterprise resource planning transition at one of their business areas for just totally choking up collections.
Yeah, it completely strangled their working capital. And the market reacted exactly how you would expect. The stock had been grinding steadily higher for the first couple months of the quarter, but we saw this massive, sharp pre-market sell-off. It gapped down hard from around 560 and eventually closed the day down over 5%.
Okay, so wait, is it just a billing delay? Because surely they're still making the actual products. What else is driving that margin compression?
Well, it's not just IT. The Aeronautics segment profit dropped 14%. They took a $125 million hit on F-16s, mostly from flight test rework and design delays, and then another $55 million on C-130s for supplier bottlenecks. So physical execution is definitely lagging too.
It feels like such a paradox because on the exact same call, you have CEO Jim Teichlet telling this incredible story about the Midnight Hammer operation, how their F-35s are in the Middle East right now acting as these invisible flying command posts, just seamlessly parsing and decoding target data. The product itself is clearly working flawlessly in combat.
Right, but combat effectiveness does not instantly equal financial efficiency. Although there is a massive structural shift happening underneath all this short-term noise. To fix these capacity bottlenecks, they're completely changing how they negotiate their contracts to protect themselves from inflation.
All right, let's get into the details on that because changing how you scale up production with the Pentagon sounds like the real story here.
It is absolutely the real story because historically, defense contractors get caught in this pretty terrible trap. The Pentagon says they need 3 times as many Patriot missiles tomorrow, so a company like Lockheed spends billions of their own capital to stand up new factories. But then, maybe 3 years later, an administration changes, priorities shift, the budget gets slashed, and the company is just left holding an empty, very expensive bag.
Right. It is the classic, the bait and switch of military procurement. You scale up, you take all the risk, and the taxpayer kind of shrugs if the political winds change.
Exactly. But management made it very clear this quarter that they are just not playing that game anymore. They basically demanded commercial-style protections. Jim Teichlet actually said on the call, and I have the quote right here, he said, "There are clawback arrangements with the government in the agreements and will be in the contracts to make sure that we're whole."
Wow. Okay, so they forced the Pentagon to basically underwrite the physical real estate and the factory scale-ups. That is honestly unprecedented leverage.
It really is. I mean, they are trying to scale Patriot Interceptor production up to 2,000 a year. That takes years of intense capital expenditure. They're setting up a specialized munitions acceleration center in Arkansas just to train human labor on new robotics. All of that takes heavy cash, and they want
want inflation escalators and cancellation protections legally baked in before they dig the foundations.
Which makes total sense, because if you do not have those guarantees, you're basically subsidizing national security with your own balance sheet.
Yes.
But I'm wondering, does that explain the weird capital allocation this quarter? Because something really stood out to me on the share repurchases.
Oh, you mean the fact that they spent nothing?
Yes, $0, like a complete halt. They bought back $750 million in stock this exact same time last year, and this quarter they just totally closed the tap.
Well, look at the board. Put the pieces together. You have a negative $291 million free cash flow because your billing system is a mess. You have heavy capital requirements to build these new robotic facilities. And look, you just don't buy back stock when the thermal budget of your balance sheet is running that hot. It's an immediate capital conservation move.
I guess that's just smart management, or actually forced management. You cannot play financial engineering games when literal cash collections are jammed up in an IT transition. I meant ERP transition. Same thing, really.
It's the same thing, yes. But I actually respect the discipline there. They saw the working capital squeeze from the software issue, they saw the facility investments coming due, and they instantly pulled the lever on buybacks. No hesitation. They still have an $8.3 billion authorization pipeline they can tap later.
That's true. They are keeping their powder dry. So they have this painful software delay, choking their cash flow, but they're completely rewiring their contracts and their factory capacity underneath it all. So where does that leave their structural trajectory, I guess, as we look ahead to the rest of the year?
Well, it leaves them... Look, they are officially telling Wall Street to be patient. Management reaffirmed the 2026 outlook, but they made it very clear that everything is heavily back-end loaded. Evan Scott, the CFO, expects that whole ERP transition to be back on track by the second quarter. So margins should really only recover in the second half of the year.
Right, which is kind of your classic trust us, the checks are in the mail guidance. But do we actually buy it?
I actually think so, because they are retiring some massive existential risks behind the scenes. Take that classified Aeronautics project, the one that has bled almost $2 billion historically.
Oh, right. The one they literally got hit with an investor lawsuit over back in January?
Exactly. Jim Teichlet went on record this quarter saying they took zero charges on it. Quote, "I feel better about that program than I have probably since I got here 6 years ago."
Wow. Okay, so if they really have walled off the bleed on the classified side, and they have the government legally protecting their new factory investments, it seems like the only thing really hurting them right now is just their own back office.
Basically, yes, which is incredible.
It really is. I mean, they are building an entirely standalone, air-gapped AI center on their own GPUs just to process classified data safely. They can handle that level of complexity, but they still need 6 months to get a bill out the door.
That is the defense industry in a nutshell. But look, if they hit their aircraft delivery milestones later this year, they come out of 2026 as a fundamentally safer, higher-floored business. The strategy is sound. They just have to survive their own operations.
I feel like we could put that on a t-shirt for almost every company we cover.
True, but here the stakes are slightly higher than a bad ad campaign.
Fair enough. A brilliant long-term defense strategy, currently fighting a ground war against its own software upgrade. We will definitely be watching how that second half shapes up. All right, that is the reality check for today. Bye, everyone.
Catch you next time.
If you like having these quick breakdowns just magically show up in your feed, go ahead and follow the podcast. And just as a quick heads up, this whole show is an experiment where we use AI to help sort through the mountains of corporate filings so we can actually focus on the story. We would absolutely love to hear what tickers you want us to look at next, so just shoot us a note at earningsunscripted@datamadness.ca or grab the X link down in the show notes. Thanks for hanging out.
See you next time.